what numbers are submitted. Maybe it was about the 3 rate cut forecast that I had anticipated last year. But what bothers me is that the forecast that's most important is not panning out. I thought at this conference, I would share some good news with you. Home sales are rising, momentum is building, but we are not seeing that. The market remains very, very difficult at the moment. As you all know, the condition, the recovery has been delayed. Part of the delay in recovery, one can say, is that Federal Reserve has changed their outlook. So last year, they were anticipating this year's economic growth will be very respectable, 2.1%, inflation pretty much under control at 2.5. But they changed it. They said President Trump's tariffs is causing a lot of uncertainty, so they have lowered the economic growth and raised the inflation expectation, and with the Federal Reserve saying, oh, higher inflation potential, we are on pause. We cannot cut interest rate. Now, President Trump saw this, and in a way, only President Trump can respond. He said, Jay Powell is a fool, he is an idiot. This is the Fed rate policy over time. Sometimes it goes up, sometimes it goes down. You look at towards the end, look at the steep rise that occurred from the middle of 2022. That killed off the market. That's when the mortgage rate went from 3%, 4%, 5, 6, 7%, one time 8%. It's right now suddenly at 8%, but that huge increase, sudden, fast jacking up of the rates has really hurt the real estate market. Now, the Federal Reserve did cut interest rate in September of last year, but it did not really have impact on mortgage rates. The market, the bond market, is still trying to assess what is the first round of rate cut by the Federal Reserve mean. But the next round, when the Fed cuts the next round of rate cut, they will be doing so because inflation is fully under control, which means the bond market should be behaving much better, and mortgage rate can go down along with the Federal Reserve rate cut. So last year's small rate cut from very, very high levels did not do anything, but when the Federal Reserve does the next rounds of rate cut, I think it can have a meaningful impact on mortgage rates. So first, we know that Federal Reserve policy and mortgage rate, it is indirectly tied up. So when they raise rates, mortgage rate increased. When they cut interest rate, well, mortgage rate did not decline. But it does follow pretty much one-to-one. The red is the mortgage rate, green is the 10-year Treasury yield, so it does follow one-to-one. So Treasury yield, in a sense, has not been fully behaving along with the Federal Reserve policy of trying to do the rate cut. But if we look at this graph, the gap, the spread between the two, well, it is a little abnormal. And here's the illustration. This is the spread between the two. So you can essentially put a ruler straight through the middle of the line and say that generally, the spread between the two will be about 150 basis point or 200 basis point at most. In simple language, today's 10-year Treasury is at 4.4%. Mortgage rate today should be at 6.4 or even 6% possibility today under normal spread. Rather, we are at 7% because of the larger than normal spread. Maybe this is due to the fact that there was some uncertainty regarding the reform of Fannie and Freddie. But as NAR advocated for the government guarantee, President Trump said, well, we're going to assure when Fannie and Freddie is privatized, we will have government guarantee. And Democrats in Congress have said, yes, it must have a government guarantee, essentially listening to the Realtor voice. So thank you for your participation in the voice. But it's not fully, the spread is not fully back down. Maybe the downgrade of the national debt is also causing uncertainty. Maybe that's also. But once it returns to normal, automatically, even before the Fed rate cut, we can have lower mortgage rates. Now, because mortgage rates are high, this is the end result for average Americans. Your past clients are all happy. Whatever monthly payment it is fixed. It is not changing. But for the new buyers who are entering the market, their monthly payment obligation has greatly risen with the higher mortgage rates. And this is what's killing the market. So how do we solve this? Well, one way is to make sure that income steadily outpaces home price growth. And that's what's happening in today's market condition in many, many parts of the country. Income is outpacing home price growth, so that's gonna help a bit. But the big influence is really mortgage rate coming down. So the mortgage rate is the magic bullet, and we are just waiting and waiting as to when that could come down. So Federal Reserve, their forecast, if you remember the very first graph, they are anticipating 2.5% inflation this year. Guess what? Latest reading on the consumer price inflation is 2.3%. Lower than the Federal Reserve. You can say Federal Reserve is already off. You're already off in terms of your forecast. But that target rate, never explicitly stated, but implicitly implied is around 2%. So we're not there yet, but we're very, very close to that. The blue arrow that you see is September of last year when the Federal Reserve did cut interest rate, because they thought that line was trending towards 2% before showing some little resistance. But now, as you can see, it is coming down much better. So Federal Reserve will cut interest rate once inflation is fully under control or going into the 2%. Tariff uncertainty, Federal Reserve has indicated. But what about other forces? That is less discussed. You see on financial papers, everything is about tariff, how that's going to raise prices. But there are other forces out there. For example, the shelter component is the biggest weight to the consumer price inflation. Everyone wants to talk about the price of eggs. Is it up today or is it down? Price of egg is irrelevant to the weight of the consumer price inflation. It is less than 1%. To be precise, it is less than half of 1%. Egg is really relevant. Shelter cost is the big heavyweight, 1/3 of the weight, and the shelter cost is coming down. And the trend line continued to say it will be disinflationary. Deregulation. President Trump does not like regulation. Too much paperwork for the business operators. Let's lower the regulation. You reduce the business operating costs, maybe that some of those costs can be passed on to the consumers in terms of lower prices. Oil prices are back to pre-COVID levels. Realtors benefit, realtors thrive much more than the average Americans, nature of your business. But also all the truckers, 18-wheelers, delivering food, delivering many, many things, lower transportation costs. Some people, like Elon Musk, is saying tariff is not a good thing, but reciprocal tariff is a wonderful thing. So what is a reciprocal tariff? China has a tariff on American products. South Korea has a tariff on American products. You lower your tariffs, we will lower ours. So maybe right now the tariff discussion is only not an end game, but just a beginning negotiating stage to say, you lower your tariff and we will lower our tariffs. Potentially weaker economy could be disinflationary, but recently the dollar has weakened, which could be inflationary. Maybe China, just to show that it can exert financial power to the US economy, maybe dumping the dollar into the market, making a weaker condition. But the new development last month is pharmaceutical drug, which could be disinflationary, which I'm going to go into a little more detail. So here's the heavyweight, shelter costs. Many people do not attend in person. They just look at the slides. I have to put the egg price down. But the shelter cost component, as you can see, shot up. So rents were rising very fast 2-3 years ago, but not anymore. It's trending downward, and in some market, oversupply of new apartment construction is coming into the market today. So all the forces are indicating that the heavyweight component will calm down. Gasoline prices back to pre-COVID. And here's the prescription, non-prescription drugs. Canada, a free ride of United States national defense. Oh, America will protect us. We don't have to spend money on national defense. And also pharmaceutical drug. Let Americans pay for the research and development, and then the marginal cost of producing that drug is so minimal, but they can sell it cheaply to Canada for low prices, or to Britain. President Trump essentially said, whatever you sell to Canada, whatever price you place on Britain, France, and other developed countries, this is what the American consumers will pay. So we will see how this potential could lower some of the inflationary pressure on the medicine costs. Now, some economists are saying American medical prices may not go down at all, but rather Canadian medical prices may be rising from this policy. We have to wait and see how it develops. Now let me turn to the job market. Because once the inflation is under control, again, everyone is talking about the tariffs, but let's also consider other forces that is at play. Maybe less visible, maybe it takes a little time, but there are certainly other forces that could bring the inflation to a much better condition. Related to the job, after the disruption of the COVID at the beginning of the graph, 20 million job losses during the lockdown, more jobs, such that now we have 7 million more Americans working. This is all potential housing demand. We know home sales are very low, but to the degree that people believe that buying a home is part of their American dream, all the potential housing demand continues to build up. If we look at market by market, you cannot read the figures, but it's color-coded. Greens are the superstars. It's very, very fast job growth. Better than 10% job growth from pre-COVID highs to the latest reading. Dark blue, essentially above national average, and light blue, positive, which is a good news, a little sluggish. Hawaii is a different color. A lot of realtors from Hawaii, a lot of people from Hawaii. When they told me that ever since Maui was hit with a wildfire, thank you for people who are sending money to Realtor Relief Fund. Do you know that realtors do not like scams? 100% of the money go in, 100% of the money goes out. So 2,000 buildings have been destroyed during the wildfire in Maui a few years ago. How many new construction? Only 10. Our economic analysis shows that you build more homes, do more home sales, that's positive economic generation. So once we get that home construction underway, Hawaii will definitely be turning positive. Now looking at the momentum, not a 5-year timeline, but just looking at 1-year timeline, you see a little different. So again, dark color will be better. The orange is actually negative. So somehow Arizona, I'm going to go back to the prior chart. So we have to first identify where Arizona is. It's negative in this chart. So Arizona is one of the top performers, but in the past 1 year, they hit a roadblock. So they're losing momentum right now. So you can assess in your state how it did over 5 years and how is it doing currently to assess the momentum. Blue is the consumer price inflation. Beginning of the graph shows what happened 3 years ago when you went to the grocery store, came out very angry. We remember that period. But today, the wage, red line, is above the blue line. Current Treasury Secretary Besson said, look, I'm not watching the stock market. The stock market ownership, top 1% of Americans own half of the stock market wealth. Okay, it goes up, it goes down, I don't care. What I care about is this graph, according to Treasury Secretary. He wants average Americans' standard of living to be rising, and he said we have more jobs, and their standard of living, red line, is above the blue. So tariffs, others, how stock market react, I'm not watching, I'm looking at this graph of condition. But that helps on the housing affordability. But let's look at the residential market. Home sales has been very, very difficult past 2 years. If I stretch the line for the past 30 years, we have had lowest home sales in 30 years. for 2 consecutive years. And when we look at the monthly data, we are not seeing a recovery yet in 2025. And is it going to be another year of difficult home sales environment unless the second half really begins to improve? This is the raw count of the data. Nature of the economic data is we have to seasonally adjust it. It goes through some modification. All the government economic data release goes through that process, so we do it. But for ordinary realtors, ordinary consumers, you care about how many home sales each month, and what you see is that there's 4 more home sales in late spring and in summer months. In winter months, much calmer, so you see the actual raw count. So we are getting that little upward bump from the spring buying season, but let's see how it plays out in the second half of the year. So the light at the end of the tunnel, I thought I saw this in Boston conference where some of you attended, because this is a year-over-year change. Compared to 1 year before, are we seeing better momentum? And at least through November of last year, it was turning positive. Home sales were rising from very, very low levels, and it flickered out. But here's an interesting graph. This is a mortgage application to buy a home. Essentially, you can say much early leading indicator about housing demand, and the pool of people on the fence ready to jump in. After having been negative for multiple years, is consistently on a positive ground. And I think the latest reading is 20% above 1 year ago. 20% above. Just imagine if your home sales were 20% higher, well, mortgage application is 20% higher, just to buy a home, not refinance, excluding refinances. So housing demand appears to be just there, but not getting realized at the moment. This is one headline from last week. Buyers rush into the market, new home sales in April, 3-year high. So the builders are in a different market compared to the realtors somehow. I put that little red arrow to say, well, the reasoning for the builder sales being so high is they're offering incentives at lower prices. First, this is the chart on new home sales. So pre-COVID and post-COVID low interest rate boom frenzy activity, then calming down, but the latest data point 3-year high, and it is above pre-COVID. While realtors are experiencing 30-year low in home sales. Inventory situation. Builders are planning for inventory. Realtors, as we all know about the lock-in effect, we are waiting for the past client to list their property, and now slowly they're coming around. Life-changing events is inducing more inventory to come to the market, but the builders have plenty of inventory, and one consequence of plenty of inventory is not more choices for the consumer, but sometimes they have to do the economics, lower the price, offer more incentives. So this is the price difference between new home and existing home. Red is new, modern, always a little more expensive, about 15 to 20% premium, but lately, or in fact, past 3 years, new home prices have actually been falling. Part of that reflection is they're building more smaller size homes, more affordable homes. And here's another incentive. Let's say you're trying to sell a home, and your seller is saying, yeah, somehow, let's give a little more incentive. What kind of incentive? Why don't we just reduce the price by $20,000? But the builders, rather than reducing the price by $20,000, they're saying, let's use this $20,000 for mortgage rate buy down. And by doing so, they have lowered the monthly payment costs, and consumers are somehow responding to that lower monthly payment costs over the lower home prices. So at least the builders are in that situation to play around with the mortgage rate a little better than say the realtors or your client past sellers. But in the meantime, home prices are at a record high. I met a realtor from Maine in the hallway and said, please repeat again. Maine is #1 in home price growth. 75% price gain over the past 5 years. Huge wealth gain for people who are property owners. But every state has enjoyed sizable gains, whether 40%, 50%, very high. So when you review this chart, you can see the figure much more closely, but it shows the variation. What about 1 year momentum? Not 5 years, 1 year momentum. Well, here's the chart, and Puerto Rico is #1. I know we have at least 1 or 2 realtors from Puerto Rico coming here. But we are also finding affordable markets, Midwestern markets, Ohio, Michigan, due to their affordability, attracting more buyers, upstate New York. So that is where we're seeing more price appreciation, where things were very affordable, or there were laggers in terms of they were sort of following. They did not really participate in the huge price growth, but now they're beginning to participate. Consequence of the huge price growth is the wealth buildup. It shows by the tenure. So the blue is for people, homeowners in Denver. If you own a home for 10 years, it's way on the right-hand side. Essentially, you listed $400,000 in housing equity gain. The red is Louisville. If you look at the beginning years, Louisville is outperforming Denver, in recent years, but over the long period, you see the condition. But everybody's positive. Home ownership bringing wealth to homeowners. The graph that is most popular, most utilized, something you already know, but still worth repeating. Homeowners have wealth, renters simply don't. That's why we are here trying to advance homeownership opportunity for more Americans. Could home prices crash? Here's the graph. Mortgage default rate is showing we are at historically low, it will not crash. The red arrow is 2008, 2009 period, but everything crashed. But some people are saying, well, FHA has a higher default rate than in the red, but FHA purposely is designed for people with slightly lower credit score, first-time buyers, so naturally they will have higher default rate, but historically, you just compare red line with other red line points, it's still at historically low. Home prices are not on the verge of any crash. Days on the market is lengthening. My next speaker, Danielle, she has many things on it, so I'm going to let her do more discussion of that. But when we took a survey of the realtors, even the days of the market is lengthening, is the staging important? And the answer is yes. And depending on where you stage, like the living room, primary bedroom, those appear to have a bigger impact compared to trying to upgrade the guest room and part. But all this report we have available. My colleague Jessica Lost and her team to do a wonderful job in creating this graph. This is price cuts from days on the market. So sometimes media report home prices are crashing because of the price cut. Now this is even after the price cut, home prices are still at a record high. Some homeowners sort of misplaced their home prices from the beginning, but we know the common sense. Homes are staying on the market for a long period, you reduce prices, so it shows days on the market and how much price cuts are happening in order to get the sales done. But one interesting part is the middle column and the last column. Last column is pre-COVID, 2019, April, while the middle column is recent. And what you find is that for the same days on the market, there appears to be deeper price cuts now than before. RPR has very localized data, so you all know about that. So let's go to the forecast. So the forecast is, I have not changed it. And I hope the important forecast plays out, because somehow the Wall Street Journal sounds good, but I'm not happy. I'm not happy that you are not, you want to see more home sales. I want to say you want to see more people advance to the home ownership rate. So the forecast for this year is home sales, because of the better second half, picking up 6%, new home sales 10%, mortgage rate settling down near 6%, combination of the rate cut, along with the fact that spread between the 10-year treasury and the 30-year fixed rate may be lowered. The other part is job gains continuing. But there are some risks. We know that national debt levels are very high. We need to ensure that we do the tax package in the right way, in a beautiful way, but we also need to address about the future deficit. But here's the why we have the deficit. Red is the government spending, green is the tax revenue. The box is what happened since COVID. Once government spends, it's hard to pull it out. As soon as you pull it out, people scream. So is it the case of green line needs to go up more, or is it the case the red line needs to come down somewhat? We have to make this decision, otherwise, in 10 years, Social Security check will be cut in by 20%. Money is running out. Gold prices, record high, partly reflecting great uncertainty. But I want to put this graph in a realistic context in the following. In other countries, they consider real estate as a safety haven, gold as a safety haven. So the fact that gold prices have risen so much, home prices, we know, are high. But at some point, the home prices suddenly begin to take off as things like this graph never gets under control. One wonders. And this is the latest survey of renters. Renters want to participate in home ownership. Strongly prefer owning in different, you see the graph, according to the New York Federal Reserve. Their desire and aspiration is there. But the possibility has become difficult because of high mortgage rates and some tax policy part, or maybe they could do more pool tax policy to own a home, but the aspiration is clearly there. So thank you everyone for trying to shift this aspiration into that realization into the future, because this is what the success of America would represent. So thank you very much.